In this video, I'm going to be sharing how you as a landlord or maybe a property investor can do an assisted sale, a technique that we use to solve a problem. I've got some paper here that I can draw up and understand exactly what that looks like. Starting off, let's find what the problem is. And most assisted sales start off with a property that's on the market. So this property is being sold. In this specific scenario, the homeowner has the assets, they're asset rich, but they don't have the cash to do the works to get to the real value of the property. So we had agents value this at £300,000. The agents said that this same property refurbished and recirculated in the current market would get a minimum of £350,000. So you can see there's a huge uplift in value. We went round, we had a look at the amount of works that we need to do, and we estimate that to be £28,000 worth of works. That includes, this particular property's had a leak. There was a burst pipe which basically ruined the ceiling of the kitchen and some other areas of the property. The issue here and the problem that he's resolving is the vendor that owns a £300,000 house doesn't have the £28,000 to do the work to release the £350,000 of the property. So what are their options? They could sell it for 300. They could find the money for £28,000, which is quite a lot of money, specifically if you're not necessarily commercially doing this, to achieve the £350,000. Once you look at the £350,000, if they did sell the property, they would obviously have agent fees, legal fees associated with that. So they're actually going to be taking away a lot less than 300,000. That's the vendor's perspective. Now let's take a look at that from the buyer's perspective, who's us. So the reason I say buyer is this is the reason that we're not buying the property. So if we wanted to buy this property and realize a gross development value of £350,000, we need to spend £28,000 on refurb. We would need to spend a subsequent amount on stamp duty. Let's assume that we agree a slightly lower price on this. The stamp duty for a £280,000 purchase is 10k for that, and that's for a limited company, limited SDLT costs. So as you can see, once you deduct £28,000 worth of works and £10,000 worth of stamp duty, and then let's assume £5,000 for legals, etc. This isn't even including finance. We end up not making a profit buying this for £300,000. So this makes this not viable to buy the property, renovate it and sell it. So you're in this catch-22 where a seller wants to exit their property. It should be worth more than it currently is. They don't have the funds to deliver what needs to be done to get the good values. And we as a business can't buy it because if you work out these figures, we'll round that up to 30 for refurb for contingency. So that's £45,000 spend, which equals a total of £305,000. So if we bought that off the vendor for £305,000, we would make zero profit. And this isn't even factoring in our time, finance costs, and any unforeseens that might be within the property that we can't resolve. So what is the solution for this? The solution is an assisted sale. And what we do in an assisted sale is completely negate any stamp duty costs and most of the legal costs. So those costs can get thrown back into profit. It's essentially where the vendor puts their house in as the joint venture. We as a company come in and do all of the works, manage it all, bring our expertise, any reconfigurations that need doing. We pay for all of the refurb works and we then sell the property at the back end. What we have to agree with the seller is a lock-in price. So for this example, we've locked in £300,000 worth of value. So in the joint venture, the vendor puts in the house and we put in the works costs. Once you add these two up together, you end up with the total costs and then you end up with a profit that you can deduct off your total costs, and that is split 50%, 50% each way. And I know what you're thinking, it's quite a small project or it might be large if you're not doing these, but what we're aiming to do is provide a solution. So let me run you through the exact numbers. Now you can see that the vendor's going to struggle to sell their property and get £300,000 for their property. They ideally want more because they know it's worth £350,000. We would struggle to buy that property off them because of these associated costs, leaving no profit margin. And there's no point doing any projects unless there's a profit margin. It's a little different if you want to keep to rent, but in this scenario, we're flipping the property. So we want to see a return on our cash. So now we've talked about the theory of an assisted sale. Let me run you through of how this project actually is going to pan out and what we're going to achieve for both us and the vendor, and also what our rate of return is. The way that it's structured is discussed. Vendor's putting the house in, we're bringing the works, and then we're selling the property. The vendor maintains ownership throughout all of that, and we're trying to achieve best value for the owner. The house goes into the joint venture with we call it a strike price of £300,000. That's the vendor's part of the joint venture to achieve 50% of the scheme. We then obviously have a legal cost to get a joint venture agreement drawn up with the owner. We actually have templates of these, but you should expect about £500 to £1,000. But obviously to buy an asset, we'd be looking at a substantially more amount of money from a legal perspective. So with the legal cost being quite slender compared to a purchase, that is normally saving about £4,000 if it were to not be a assisted sale. Moving on from that, works cost, these are the same whether it's an assisted sale or not. So we had those we've actually got it at 27.2k. That is what Central Suites, the property person's paying for. You can see the vendor hasn't actually had any real expense to date. Additional to that, we have to factor in sales costs. So this is your agent's fees, where it'll be 1% plus VAT. Let's assume that there's a hurdle or a legal fee associated with that as well, and we call that £5,000. This is paid once sold, so there's no upfront costs there. We then have finance costs, which in this scenario, as a joint venture and an assisted sale, there is zero. Sometimes the property might be mortgaged, but it might be on a buy-to-let mortgage, which would be cheaper than what finance we could get anyway to turn the property around. To conclude that, we then have our total cost figure, which is everything that it's costing. So this is the strike value, legal cost of works, and the sales. Given all of these and some other figures, that actually comes in at £332,000 and 500. So that's our total cost figure. So whatever we sell the property for more, and that's including all these figures, is then profit. So we originally mentioned that the gross development value, or the end value, was £350,000. Our net margin collectively is £17,500. And what do we do with that? We split that 50-50 with the homeowner. So what the homeowner gets is their original 300 that we agreed, 300k plus half of the 17,500, which is 8,750. So they walk away with £308,750 for probably within size 6 months work, and we walk away with 8,750. Now you're probably thinking that's quite a low figure for a business like ours. But what I would want to sort of bring our attention to is what it's actually cost us as a business. Obviously, great win-win here. The homeowner has walked away with more than they anticipated, and it's normally, when she finishes the property, it's a quicker sale anyway because it's less dirty and grotty. But from our perspective as Central Suites, I want to now sort of bring you into the understanding of what this means for us. Let's assume that we've paid for the legal costs. We have stumped up a total of about £28,000 doing this exercise. Our profit is £8,750. So that's within 6 months, we've got an £8,750 return on our money, which from a return on investment perspective is 32.11%, and an IRR, which is your indefinite rate of return, that's your return per annum, is 64.22%. So as you can see, these figures are really attractive. It's quite a lot of work for a small end of profit, but these figures are really interesting. If you know anyone else out there getting 60% IRR and 30% back on their money, that's a really, really strong return. One other thing that I would like to allude to is the agent said that if it was refurbed, it would be worth 350 to potentially 370. So as you can see, if the property does end up selling for upwards of 370, our profit margin is subsequently higher, and it would then be looking like we'd be making not 8,750, it would actually be 18,000. So you can do the maths on IRR and return, but that is exactly how we partner with homeowners that are struggling to get true value for their property. We bring the expertise and the funds to do the works. We create a much better, more saleable asset for a first-time buyer, family, whatever it may be. We trade that back onto the market. We joint venture together, and we both end up with a profitable result.